Hi there, welcome to Kneppy Invest. Recently, I have developed an investing checklist, which I have written down, put in paper, and I really want to follow this investing checklist to the law. And I have gone through a lot of research to develop some criterias, and then within these criterias, I do have a few checklist points that I really need to satisfy, well, a company needs to satisfy before I really think about investing in that company. And when I typically look at a company's half yearly and yearly financial reports, I will tend to first go to the cash flow statement and then work my way backwards to the balance sheet and the profit and loss statement. But recently, I've been finding myself looking at the revenue first and then going to the cash flow statement. So, in a way, I have realized that revenue growth is one of the, if not the most important financial metric for the long term viability of a business. Now, I won't say it is by far the most important financial metric. I'll probably also put gross margins, profit growth, cash flow growth as some of the other financial metrics, return on equity, return on invested capital, some of the other really important investing or financial metrics that I do look at as well. So in this video, I'm going to briefly touch upon revenue growth and why it is important, and then also focus why I've honed in on 10% revenue growth as a very important starting point when I'm looking or researching a company. Now, a brief refresher on the three criteria in my investing checklist. They are quality, value, and sentiment. Value and sentiment are fairly obvious. So I'm looking at whether a company is overvalued or undervalued based off a certain metrics I am looking at. And sentiment is just the charts. Is the share price in an uptrend or downtrend? When it comes to quality, I've actually broken that down into growth, profitability, and also have a qual, which is just short for quality. Now, qual just focus on shares on issue, change. So, are a company or is a company doing a lot of capital raisings? So, are we seeing shares on issue increasing through time? Return on invested capital, return on equity, debt, which is another very important thing I look at, another important financial metric. Profitability focuses on operating cash flow, free cash flow, profit, and gross margins. And growth focus on growth in revenue per share, operating cash flow, free cash flow, equity growth, and also earnings per share. So I'm looking at those metrics growing through time. Now, when it comes to the importance of value or sentiment, now quality is very important. So we're going to be determining the quality of a company. Is it high or is it low? And then when it comes to value and sentiment tends to be less important for high quality while value tends to be more important. And a perfect example of this is Microsoft about 20 years ago. I would probably define Microsoft as a high quality company that was still growing, but the share price over about a 6 to 7 year period just went sideways, did nothing. And that's because the value of that company was exceedingly high in the start of, say, 1999 into 2000. And that means even though the company was growing, that growth had to catch up to that value that was assigned to the company. So again, value is very important when it comes to high quality company. You don't want to be going out there and just buying a high quality company, regardless of the value of that company at that point in time. Now on to why revenue growth is important. I probably was thinking this is quite obvious, because you want to be buying into a company that is growing. And revenue growth is very important to determining whether a company is high quality or low quality. Is a company gaining more customers? Is a company producing more products? That's very important as well. Or are the customers of a company buying more stuff from or using their services more and more during the customer client or customer company relationship? Now, how you value a company is really important. So you just take the present value of all future cash flows. So you typically want cash flows to be increasing through time to value a company higher. And of course, the best way to get profit or cash flow growth is to grow revenue. It's actually not the only way You can also grow revenue by growing your margins, or also by cutting your spending. But unfortunately, um, margin growth is finite. Cost cutting is finite as well. So if you have margins of say 70%, you can't go above 100%. There's a finite limit to margin growth, just like there is a finite limit to cost cutting growth or cost cutting. And so sometimes you will see companies increasing their profit, their cash flow, by increasing the margins or decreasing their spending. But again, those are finite ways to increase your cash flow or your profit. So we're looking at a way to infinitely increase your cash flows or profit. And the best way to do that is to increase your revenue. Hence, why revenue growth is really important. Why have I decided upon 10% revenue growth? Why not 20%? Why not 5%? And I've really honed in on 10% in the last few weeks. About 3 or 4 weeks ago, I had not assigned a number to revenue growth. I was undecided about exactly what I would choose. But recently, I've just honed in on 10%, and that is the number I have decided upon for a few reasons. The first reason is very subjective. And in my opinion, at least a 10% revenue growth per year. Now, I'm not talking about, when I say per year, I'm not saying every single year must be 10% or at least 10%. And in fact, the first company I'm going to be looking at in regards to looking at the financial year 22 numbers is Altium. And financial year 22 was very successful. Altium share price popped up 20% on the back of their financial results. But if you look at the last 2 years, financial year 20, financial year 21, their revenue growth was significantly less than 10%. But I had expected the revenue growth would return to be above 10% for Altium, and it has in financial year 22. So I'm not looking at every single year in isolation and want 10% every, or at least 10% every single year, but over time, 10% revenue growth. So 10%, at least 10% revenue growth is an indication of the quality of a company, in my opinion. Now, sometimes you'll see revenue growth dropping through time, and that actually is a red flag for me, because that is suggesting a company is reaching full maturity. And I don't want to invest in a company that is fully mature, because history shows us through time, through the last 100, 200 years, that a fully mature company will have problems in the future and more than likely will wither and die over time, because newer, more nimble companies will come onto the scene and take business away from that fully mature company. So again, I want to see revenue growth not decreasing through time as well. So I think if a company can maintain at least a 10% revenue growth over time, that is a good indication of the quality of a company. The second reason why I've honed in on 10% comes back to my expected returns in the portfolios I do have. I want at least 10% returns in my portfolio. So if a company can grow their revenue growth by at least 10% per year, that is a good sign moving forward, particularly if they can maintain their margins and not increase their spending on anything. So at least a 10% revenue growth should translate to at least a 10% capital growth in the company, and that's not taking into account any dividends. So a lot of times you will see companies growing that revenue at 10% per year, and they'll also have dividends. More than likely, those dividends are going to be quite small. And this comes back to compounding and why at least a 10% revenue growth is very important over the long term. Because if a company can increase their valuation, their profits, their cash flow, their revenue by at least 10% per year, and also their dividends at least 10% per year, over time, you're going to see the value of a portfolio absolutely explode, particularly if you compare that to a fully mature company like Telstra. So they have no revenue growth over time. In fact, Telstra's revenue growth has been dropping through time, and their dividends don't grow at all. So that is one of the reasons why I'm looking at a company with at least 10% revenue growth, because I also want dividends to be growing through time as well. Now, another way to look at dividends is why not a company with zero revenue growth, but a 10% dividend yield? In fact, I was researching a company recently, in fact, yesterday, REIT, which is a real estate investment trust. And the dividend of this company, which was Centuria Office, was 10%. So they had a 10% dividend yield. So why not invest in a company with a 10% dividend yield? Isn't that the same as a company that is just growing their valuation, their revenue, their profits at 10% per year without a dividend? And I say no. So a company that is growing their revenue at 10% per year without any dividends, more than likely you will see that company issue dividends in the future. For a company like Century Office REIT with a 10% dividend yield and no growth in their bottom line, so we're looking at funds from operation, no growth there, more than likely there's going to be a chance that company will decrease their dividends in the future, particularly if they have zero growth when it comes to revenue, when it comes to funds from operation. So again, dividend growth is important in my opinion, and that is related to revenue growth, profit growth, and cash flow growth as well. And then it comes back to the importance of value. So this is very important in my opinion, and that's why it is one of the criterias. And even if you find a company with 10% revenue growth, you have to look at the value. In my opinion, you have to look at the valuation of the company. You just can't see 10% revenue growth, that's the tick, and then not look at the valuation of the company. So that's very important, and much more important when it comes to high quality companies when compared to sentiment. I will invest in the high quality company when it has really good value, yet sentiment is actually quite negative and the trend in the share price is down, because value, again, is more important, in my opinion, than sentiment for high quality companies. That's all I have for this video. If you have any thoughts, any questions, just leave in the comment section of this video. But otherwise, I am not an investing advisor. If you do need an investing advisor or financial advisor, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.